This is WealthBT, a podcast of BT correspondents.
If you are invested in the S&P 500 or even a global equities fund, you must be sitting on some very good profits. For the year 2024 up to the start of December, the S&P 500 has returned almost 27%. Returns from the MSCI World Index were also very good, only just slightly lower at more than 20%. That the World Index did well shouldn't be a surprise. That's because U.S. stocks' share of the index is very large, more than 70%. Without the U.S., the return was just around 5%. But this WealthBT episode is to help you look ahead. What can you expect from 2025? How should you be positioned? Will U.S. stocks be just as rewarding? Most of all, how should you adjust your exposures so that you continue to profit and yet not take on too much risk? Welcome to WealthBT, a podcast by BT correspondents. I'm your host, Genevieve Cua, wealth editor of the Business Times. Every week, my colleagues and I break down a business story that matters. With us in the studio is Hou Wey Fook, Chief Investment Officer of DBS Bank. Welcome to WealthBT, Wey Fook.
Thank you for having me, Jen.
So, Wey Fook, let's recap 2024. What do you see as the major developments with implications for 2025 and beyond?
Yeah, so there were a few significant developments. Of course, the US presidential election, and Trump has, of course, won it. So there could be some implications to investing in 2025. Now, the other significant event, especially for financial markets, would be the fact that the Federal Reserve actually pivoted, from like 2 to 3 years of rate hiking, they pivoted to rate cutting. And this is the first time we have seen them cut from 5.5% to where we are today, 4.75%. That has, again, a lot of implications going forward. And the third significant development is really the breakthroughs and the rise of artificial intelligence that is feeding through not just the technology sector, but across all sectors of the global economy.
Mm-hmm. This euphoria, I think, over AI has lifted many stocks, especially U.S. stocks. So how are you advising investors in terms of how they should position themselves? Is it time to trim the U.S.?
Yeah, we have always been a serial bull, in U.S. stocks. And the reason for that is because if you look at the individual companies there, they are companies under this acronym that we have come up with, IDEA, IDEA, I, which stands for innovators, D, disruptors, E, enablers, A, adapters. So if you look around the world and to source for such companies, inevitably you would conclude that US has the most of these kind of companies. Now, innovators, of course, are companies that, like the AI players, the likes of NVIDIA for their semiconductor chips. And then, of course, you've got the hyperscalers, the cloud computing giants like Amazon and Microsoft. So these are some of the companies that we realize are all coming out of the US. The other, of course, aspect would be the software services companies, again in the US, cybersecurity companies, again in the US, automation, electric vehicle, software, and all that, all are coming out of the US. So we continue to like US because it is very exciting. The companies are constantly innovating and disrupting, and they do have a very strong trajectory of double-digit returns or earnings growth for the next few years.
So, but what does that mean for Asian stocks? I mean, what do you see for Asia?
So Asia has a part to play too because we actually manufacture, the chips. For example, in Taiwan, in Korea, these are companies that are able to really manufacture very complex chips. And Asia is a fertile ground for dividend-yielding stocks. For example, in Singapore, the banks and Singapore REITs, Real Estate Investment Trust, really gives a lot of value in terms of giving you a consistent dividend payout.
So if you look across the asset classes, and we often talk about risk premium, can you help us understand what is risk premium and where do they stand today, given where markets have come?
So risk premium is really the incremental return that you capture in a bond or in a stock over cash deposits. That's called a risk premium. Now, the market has gone up a lot, and many do say that, the stock market in the US is in a bubble. So the risk premium has really come down sharply. That means going forward, the incremental return is not going to be as great. Now, on a broad basis, that may not be a wrong observation, but there are different segments of the stock market that would do differently. We continue to like technology because why the world is really digitalizing, and the pace of digitalization, the pace of innovation is so fast that certain segments of the stock market would do well. And technology for sure is one. And to a large extent too, you got to be very careful because we are living in a world that is changing so fast. There is a huge existential risk among incumbent business models that cannot adapt to this new digital economy that we're in. A case in point is electric vehicles versus internal combustion. If you are an ICE traditional automaker and you cannot pivot to manufacture EV, then the risk of obsolescence is extremely high. So look for companies that can adapt, which is why we have this acronym IDEA, A standing for adapters. Really traditional companies, but able to adapt to the digital economy.
We've just been speaking to Hou Wey Fook, CIO of DBS. In a few moments, we'll learn more about the barbell approach in a portfolio. How can this help you nail the twin objectives of income and market returns?
BT Correspondence welcomes Transport BT, the newest member in the channel's lineup, providing in-depth commentary and a 360 view on all things transport. Join correspondent Darren Wong as he explores the business of the sector and the policies that govern it. Hear from the industry leaders who will join him to provide context and insight. BT Correspondence, a new episode every Tuesday, wherever you listen to podcasts. Subscribe and listen today to BT Correspondence.
And now, back to WealthBT, a podcast of BT Correspondence.
Welcome back. So, Wey Fook, you've long advocated a barbell approach. Please tell us what this is.
Yeah, so when you are constructing a portfolio, it is important that you follow the following principles. Number one, you have to be long-term in terms of your investment orientation. Secondly, you must have a global perspective in terms of the investments that you have in your portfolio. And thirdly, you do not try to time the market by going in and out because it's almost impossible to create value out of that strategy. So what we have said to our clients is when you do a portfolio, you need to construct that portfolio such that it gives you resilience, at the same time give you attractive returns more than that of cash deposits. So we came up with this strategy called barbell, meaning you take outsized positions in two areas of focus primarily. One, income generating assets like bonds, like Singapore REITs, that gives you consistent cash flows. And on the other end of the portfolio, you buy into what we call secular growth equities, companies that really ride on long-term irreversible growth trends like technology. So when you have that kind of construct, then it's very resilient. Now, how much is it going to be in growth? How much is it going to be income? It really depends on your risk profile and your investment time horizon. So if you are conservative, you have a slightly shorter time horizon, then you want to be more exposed to income generating assets. But if you do have time in your hands, then you could add a little bit more, maybe 56% on the growth side of the portfolio.
And how is that done?
So this year, we are up about 13 to 14%. And the volatility has also been pretty subdued because, of the having a lot of bonds in that portfolio. So it's been a nice ride for our clients.
So what aspects of the market are you most concerned about?
Yeah, so the biggest risk, of course, is Trump 2.0.
Right.
The potential for tit-for-tat trade tariffs that may lead to a full-scale trade war. That is the main risk. And obviously, we are prepared for that in the way we construct our portfolios. To some extent, we have seen this movie before, under Trump 1.0, when he slapped tariffs on China goods. And in a trade war, no one is a winner. Everyone loses. So after he slapped tariffs on China, the entire world economy slowed down. And that resulted in the Federal Reserve, the Central Bank of US, cutting rates aggressively. Bonds did very well. So in our barbell portfolio construct, it's resilient against this kind of tail risk, full-scale trade war, because in that scenario, the Fed will have to cut rates to prop up growth, and bonds will be an excellent asset class.
Would the expectation of tariffs lead you to kind of trim or downsize Asian stocks?
Yeah, I think currently how we are exposed to Asian stocks is primarily in dividend plays, like Singapore REITs, Singapore banks, even China, large banks do give you a very nice dividend. So I think an escalating trade war will not have that meaningful or material impact on dividend plays. So I'm quite comfortable the way we construct our portfolio as of now.
So Wey Fook, you've been investing more than 30 years, both professionally and I presume for yourself.
Yes.
So what lessons can you share with people, like whether you as a professional or as a personal investor?
Yeah, we all invest and we all succumb to mistakes along the way, right? But there is one lesson which I thought, most retail investors is this mistake of being too frequent in terms of their trading. And why is that a mistake? It's because of this phenomenon which I call anchoring bias. Anchoring means that if you had bought a stock at $100 today, for example, and in the next week or two, the stock goes up to $150. Wow, you've made 50%. I sell it and took profit. Guess what? If that stock goes up to more than 150 or 200 and northward, it's unlikely that you will come back in because you are anchored on the price that you sold it at. And that has been many, many of such cases around the likes of Apple, Microsoft, NVIDIA. So a lot of us, including myself, at the early stage of my investment journey, try to be too smart, take profit and hope for a lower level to get back in. But lo and behold, a good company, the stock rides on a secular uptrend. And if you try to time it, lo and behold, you would lose the entire move. So one of the legendary investors in Wall Street, Peter Lynch, used to run the Magellan Fund back in the 70s. And he was making 20% compounded annual growth rate, but not many of his customers who bought into the Magellan Fund actually captured the entire big move. Because why? They have been, getting in and out. And that is something we need to be very careful about, anchoring bias. It works against human nature. And therefore, you must have a long-term orientation in terms of your core portfolio.
There's this other thing about cash, which Singaporeans love. In fact, cash rates are still kind of respectable. You can get like maybe 3% depending on the bank. What are your thoughts on this? Is it time to move out of cash?
Yeah, so today, treasury bills, for example, in Singapore gives you about 3%.
Right.
Looks very attractive, especially in comparison to the last 10, 15 years because rates were then close to zero. However, cash has never been outperforming asset class. And today, I would encourage clients to actually move out of cash, move out into something like a longer dated bond and do it through, bond funds, where you are able to capture about 4 to 5% today. And always try to do it through bond funds. Don't try to buy individual bonds. See, a portfolio of 5 bonds and a portfolio of 100 bonds both give you the same return. But you can immediately appreciate if there is a default. On your 5-name individual bond portfolio, the impact is hugely material. On a 100-name through a bond fund, at least the impact on the portfolio is not material, it's manageable.
So thank you, Wey Fook. That's a lot to think about. Thanks for dropping in.
Most welcome, Jen.
Strategists believe that exposure to the US is a must, but it's prudent not to expect the same level of returns as we've seen this year. Most of all, it's important not to fall prey to FOMO or the fear of missing out. Remember, your own portfolio is unique because it should reflect your objectives and the asset allocation you need to reach your goal. I think keeping a good balance of some risky or growth assets alongside more secure investments is sensible. It's also prudent to do some rebalancing, like trim some equities to get your balance back to your strategic weights. I hope this episode clarifies for you some themes that are likely to prevail in 2025. BT Correspondence will be back next week with a new episode on transport, so do check it out. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm Genevieve Cua. As always, thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.